How's it going today, guys? Welcome back to the channel. So in this video today, we're going to be talking about my 10 best stock market lessons that I've learned over the last 5 to 6 years investing in the stock market. So what tends to happen in the market is that beginners or even investors in general tend to make these same or similar types of mistakes. So by educating yourself about them and kind of the common, themes or trends we have as humans, it can help you to be a better investor overall. So these were the most helpful lessons to me in my stock market journey. I can't wait to share them with you guys. So let's jump right into the presentation. Okay, guys, so here we are in the presentation. These are my best stock market lessons, 10 strategies for new investors. And some of these lessons here, guys, are going to be from my own personal experience with investing over the last 5 or 6 years, but I'm also going to be weaving in a lot of the best stock market lessons from some of the greats out there like Warren Buffett, and I'll be doing my best to give credit where credit is due here, guys, but by no means am I like the first one who came up with the majority of these lessons. A lot of these are from other investors out there with a lot more experience than me, but I'm going to basically pack all of those ideas down into this video. These are the lessons that helped me the most and continue to help me on my investing journey. Now, real quick, guys, before I jump into the video, I just have to make a disclaimer here that I am not a financial advisor. This is not any kind of financial advice. This video is for entertainment purposes only, and you should always do your own due diligence before investing in anything out there. And lastly, this video is sponsored by the Motley Fool, but more on that later. Also, guys, not to beat a dead horse here because I've been mentioning this in every single video, but once again, just watch out for those spam and scam comments down below, just because there's been a lot of people posting comments about, crypto investing and all kinds of stuff and how to contact portfolio managers. So I'm never going to contact you via phone or WhatsApp or anything like that. Never going to ask you to send me money. So if any of that is happening down below, that's definitely a scam. And if you see it happening, please leave a comment that says spam or scam as a response. That way other people know and they hopefully do not fall for it. Alrighty, guys. So first of all, if you're completely new to the stock market, we're not going to cover much of the basic information here because you kind of need to have a general idea of what is going on with the stock market and how it works before most of these lessons are applicable. But this is still going to be a super valuable video, guys, either way. But if you are new to investing, guys, I used to have a course that I would sell on investing in the stock market, but over the last couple of years, because of the way that online courses have changed, I'm not really a big fan of that business model. So what I did is I completely redid that course, and it's fully available for free on YouTube. It's a 3-hour, 17-minute long step-by-step course in the stock market that would be a great supplement to this video. So I'm going to put that card up in the corner now. So let's jump right in now, guys, to the stock market lessons. And number 10 has to do with having an investment plan. And my favorite way to make the comparison here is it's like this drawing over here on the right, which is the building plans for a house. So you wouldn't exactly go out there and try to build a house without any plans. In fact, unless you were financing it yourself, you really couldn't even go to the bank and get a loan for construction without showing them your plans. That is how important it is to have a plan before you do anything, and investing is the exact same. So one of the questions you have to ask yourself is, are you actually ready to invest? And I know this is a question that a lot of people don't like because, unfortunately for most people, that is oftentimes a no. Now, does that mean that you have to totally wait to invest? Not exactly, but it does mean that you can't go and put all of your money into investments without taking care of your own financial house first. So we're talking about things like the emergency fund. Do you have that in place? We're talking about that high interest debt. If you don't have an emergency fund and you have tons of high interest credit card and consumer debt, you definitely want to start thinking about your own finances before investing in some other business out there. So that is why you need to have this plan in place. Another question you should consider is, how much do you want to invest? You shouldn't just blindly go out there and say, I'm going to invest a ton of money into these stocks, because you want to have a general plan for how much is actually you're actually looking to put into that given investment. Because if you just simply say, I want to continue investing, well, you could get caught up in a stock that continues to go lower and lower. And if you're doing that and just continuing to funnel money into that without a plan and without any prior knowledge of the market, that's where you could run into trouble. So you should always have a plan with what you're looking to do with your money, where you're looking to put it, and then how much of it you want in each individual stock. Otherwise, guys, I promise you, you're going to end up with a much larger position in some stocks than you want. So my experience with this here, guys, was with a company called General Electric. I started buying it in 2018 when I thought it was cheap, didn't really have a real plan. And so what I was doing is every time it would drop a couple dollars, I would just funnel more and more money into the stock to lower my cost basis and average down. Well, I ended up with this massive position of over 1,000 shares of General Electric at a cost basis of around $14. And earlier this year, I finally ended up selling that position for a loss because I was just dead money to me. So that is the number one thing that happens when you invest without a plan, is you end up with a much bigger position than intended. And so that is something to definitely consider there, guys. Beyond that, you should also understand what is your risk tolerance. We're going to show you how to figure that out in a little bit here. What investment platform to use. That's kind of above and beyond the scope of this video, but I just want to show you guys the questions that you should be able to answer yourself before you begin investing. Beyond that, what companies do you believe in? What are the actual companies that you love yourself that you want to put your money into and be a part owner of? What are the key indicators that you'll be checking on before investing in a given stock? Are dividends or growth more important to you? Are you looking for growing revenues? And I'm not saying this stuff to overwhelm you guys here by any means, but I'm just kind of showing you what you should be able to answer before, in my opinion, you are ready to invest. And then lastly, what are your investment goals? Now, in terms of the majority of those questions, guys, they're answered in this video here called How to Build an Investment Portfolio in 2021. It's another marathon video, guys. It's 1 hour and 6 minutes long, but it answers most of that we just covered there about the why of investing. And so I'm going to refer you over to that video, guys. I'll put the card up in the corner and go ahead and check it out after this one for more information on those topics. So lesson number 9 is to watch out for any hype in the market. Chasing the hype almost always features high volatility and dramatic spikes. And if you've been paying attention to these, meme stocks over the last couple of weeks, that is exactly what we are seeing. Now, am I telling you not to participate in these stocks at all? No. But what I am telling you is that you need to understand what you're getting yourself into. And this tends to be a problem for newer investors because this is oftentimes how a lot of people are finding out about the stock market in the first place, is they get a stock tip from a friend or a neighbor about X, Y, and Z stock or whatever it may be. And the issue is a lot of newer investors coming into the stock market do not understand what hype is. They don't understand what a speculative bubble is. And so what oftentimes happens is they put way more money than they can even afford to lose into these hype stocks. Now, again, like I said, I'm not telling you not to buy these guys. I'm not telling you to buy them. You got to make that decision yourself. But before you buy them, understand what is going on. Because the issue here is that when you're buying something that is being hyped, it is not being valued based on the fundamentals or the underlying business. The reason the price is so high is based on a retail frenzy, or just millions of people all over looking to get their hands on this given asset at this point in time. And that much demand is just going to push that price higher and higher. However, the issue becomes, how is that demand going to stay elevated? And at the end of the day, these type of hype investments turn into a big game of musical chairs. And the problem is, things tend to fall down a lot faster than they go up, and they unravel and go down much quicker. That is because the emotion of fear is much stronger than the emotion of greed in human beings. So just understand that they're going to go down much faster than they go up. A lot of people are going to get stuck in this really crazy game of musical chairs. If you can trade it, you can make money with it. Like I said, I do own some meme stocks in my portfolio, but it's a very, very small amount in a totally separate speculative portfolio. So while you can certainly make a lot of cash quick by chasing stocks, it is not sustainable, it is not repeatable, and more often than not, it results in you losing tons of money, if not your entire portfolio, especially if you're getting into options or things like that, where a 100% loss is entirely possible. So I'm going to go ahead and make fun of myself right now, guys, because this video is all about stock market lessons. And you know what? Your mistakes are oftentimes your best lessons. So about a week ago, one of my buddies texted me about Wish stock and a potential short squeeze. And in my speculative portfolio, I decided to buy some short-term call options on Wish to trade that. And the problem is I ended up sleeping in too late, and by the time I went to sell those options, the stock had already unraveled. I put about $1,000 into these call options. Now, had I woken up and sold them before the market opened, I would have just about doubled my money for $2,000. But I ended up hitting the snooze button, and I slept in, and then they were worth about $600. So I held on to them for a week, and they expired totally worthless, guys. So for me, that's okay because that's my speculative portfolio. I'm not concerned about losing that $1,000. But to somebody who has zero experience and may not understand options, that could be a big loss to them and just something that they don't feel good about overall. So just understand hype, understand what it is. It's a big game of musical chairs. Do not be the one left, holding, without a seat. Or it's also kind of like hot potato too, where someone gets stuck holding that hot potato. You got to pass it quick, and it can be dangerous for new investors. So some investors set aside a small amount for hype stocks, like, for example, GameStop in early 2021. Could be maybe 1 to 2% of your total investment portfolio. And Mark Cuban, for example, another lesson here says to invest no more than 10% of your portfolio into high-risk stocks. 10% might even be a little bit high. He may not even be talking about these wild hype speculations, but we're talking about a very small percentage of the total amount of money that you invest is what most experts would recommend putting towards these hype investments. And it can be difficult because this is oftentimes what is the most exciting, but it is a very important lesson to learn, and you should at least be familiar with hype before you buy into it. And just to show you guys an example of some of the crazy volatility, here we have GameStop stock here. So back in February, we had this original run up here where it shot up to like over $400 per share. Very shortly after, it goes to $200 per share. So about $350 down to $200, shoots back up over $300, and then goes way down to like somewhere around maybe $40 or $50 a share. And then we have another run up, and then it sells off, a smaller run up, and then it sells off. And now we're running up again with many run-ups and sell-offs. It's very difficult to time this because if you buy in up here, you might get nervous and you might sell down here. And then when it shoots up here again, you might get mad and then rebuy it again. And then when it falls again, you sell again. The problem is investors typically make very emotional decisions, and when you're brand new, you're even more prone to making these decisions. That is why highly volatile hype stocks like this can be very dangerous territory. And that brings me into today's video sponsor, which is the Motley Fool. So obviously, guys, you can't exactly trust your friends and your neighbors to give you the best advice about stocks, but you may want to consider checking out what the Motley Fool has to offer. So many solo investors are looking for additional guidance. For example, how do you find the best stocks out there to hold for the long term? Well, I've been getting my information for free here, guys, from the Motley Fool since I started investing, since all the way back in 2016. And recently, I decided to sign up for their paid service called Stock Advisor just to learn about new potential investments that may be totally off my radar. Now, the main reason why I signed up for that is because I didn't want to be bombarded with dozens of different stock picks because I'm not exactly looking to buy all of those different stocks. In fact, very rarely do I add a new position to my portfolio, but I get a lot of new ideas from the Stock Advisor service. What they're going to be ending up doing. So with Stock Advisor, you're just going to get 2 new expert stock picks every single month delivered to you. You're not going to get overwhelmed with signals and all kinds of crap like that, guys. Just 2 solid picks. And in terms of the Motley Fool's track record, they have outpaced the S&P 500 by over 4-fold since the service started. And those returns are as of March 1st, 2021. And just to show you here, guys, this is a comparison of the stock picks from Stock Advisor versus the S&P 500 or the overall market. So obviously, guys, the Motley Fool has a phenomenal track record with their stock picking services. Now, again, you don't want to just blindly invest in whatever they tell you to, but you definitely may want to consider that as, stocks for further research. And this is a type of service that has great potential to pay for itself because just one good pick that makes you money could pay for a lifetime subscription of Stock Advisor. Also, guys, if you end up deciding to join the Stock Advisor service from the Motley Fool, you'll also get immediate access to their 10 best buys list now right to your email inbox. So lesson number 8 in the stock market is a simple one, and that is the lesson of patience. You need to be patient with both yourself and your investments. And this basically comes down to understanding the premise of compound interest, and it's this chart that you see here on the right. So with simple interest, that is where the original principal just earns a set interest payment, and the interest that you earn does not earn additional interest. Now, that is not how the stock market works. The way the stock market works is that it is a compounded return. So if you earned 8% on a given stock over 1 year, and then the next year you earned another 8%, well, you earned 8% on your original investment, but you also earned 8% on your 8% gain from last year. That is why early on with investing, on this curve here early on at the beginning, there's not much of a difference there between simple interest versus compound interest. That is because you need to give yourself a lot of time to grow substantial amounts of wealth, and that's going to come down to patience. But you can see as we move further out along this line, it's a more and more dramatic difference. And the compound interest chart is the exponential growth curve. And this is what makes most people out there tremendous amounts of wealth, is just patient, repetitive investment in the stock market following a given plan that has worked for other people. So doubling your money doesn't typically happen in a day or a week or a month. And if it's happened to you in the past, understand that you are the far minority of people who that happens to, and you should consider diversifying and counting yourself lucky, in my opinion. That's typically just not how the market works. With speculating, the majority of people typically lose money. So if you've speculated in the past and made a boatload of money, it might be time to think about diversifying, even just taking, your cost basis off the table and putting that into a more patient, long-term asset might be something to consider. So lesson number 7, guys, is the lesson of emotion. And again, we talked about this earlier, talking about the hype and how beginners in the stock market or new investors are often going to make impulsive decisions using their emotion. And unfortunately, that is oftentimes, more often than not, going to result in you doing exactly the wrong thing at exactly the wrong time. So basically, money and emotions do not mix well. When we go to the store or to the mall when we're emotional, we spend typically more than we should. And when we have emotions of fear and greed entering the market, well, that's exactly what played out with me here. Is, a friend of mine reached out to me about Wish, and I got greedy, and I said, yeah, let me get a piece piece of that, let me speculate. And that exact outcome of me blowing up that money and basically taking $1,000 and setting it on fire, that is more often than not the outcome of speculation. Now, I have completely separated my emotions from my money, which is something that you really need to do to get ahead in life, honestly, guys. But just in terms of the stock market, understand that you're prone to make these emotional decisions. So what often hurts an investor's return the most is not fees or anything like that. It's unbridled or uncontrolled emotion. Stocks can and will swing up and down at any given moment, which is going to cause investors to panic sell or become greedy. If you are unable to stomach large swings, you should most likely choose investments with less risk, such as an index fund. That way you're not holding individual stocks. And as a general rule of thumb, if you do own individual stocks, you should at some point in time be prepared for every stock you own at some point is probably going to have a 20% correction at one point or another. There's never been a single stock that I've owned so far that has not had that occur with it. Maybe National Grid, the utility stock, I can't quite remember, but you need to keep that in the back of your head. It's going to happen at some point, no matter what you buy. Even with blue chips, it's entirely possible. And if you speculate, you should be ready to have 40, 50, 60, 70% loss. And if you're doing options, 100% loss is what should be in the back of your mind. And if all of that's sounding scary to you, index funds are probably more your cup of tea. But the good news is, guys, if you followed the earlier lessons here and you do develop a rock solid plan, that should entirely take your emotion out of the equation. Because at the end of the day, if you have a set plan that you're following, there should be no emotional involvement whatsoever. If you plan out when you're going to buy stocks and then when you're going to sell them, if you're trading, for example, there's no guesswork in there. There's no emotion whatsoever. But oftentimes, the more common emotion that I see, other than panic selling, that's probably number one, but number two is greed and riding a winner into a loser. I've done it myself so many times. I've seen it done so many times. That is when you have money in your account, you're up, you're green, but you think you can make even more money by holding for longer. And at the end of the day, guys, there's a price for everything. So that is why I like the idea too of planning your positions if you're trading before you even buy the stock. You might even want to have a general idea of here's how long I want to hold on to it, and this is the general range of what I want to sell it for. And then stick to that plan, be as disciplined as possible, and keep your emotions at the door to the degree that you can. Emotional decisions and money do not mix. So number 6 is a quick one, guys. Understand fees and taxes. So this is important with investments because fees are something that you oftentimes are paying every single month or potentially every single year. And while 1% or something like that may not sound like a lot of money, when you consider the costs of 1% over 30 years, well, that becomes a much bigger figure. So before investing in anything out there, you should be able to answer these questions. First of all, what commissions, if any, does the platform charge? Now, a lot of brokerages are now offering commission-free trading, which is definitely a plus, but for overseas investors or, those who may be using older brokerages, this still does come into play. So you want to consider what are the costs associated with trading. After that, if you are looking at a mutual fund or a index fund, another thing to consider is the expense ratio, or for a mutual fund, the management fee. These are things also to consider if you're looking at any type of robo investment platform. Do they have a subscription fee? Is it completely free? These questions you need to be able to answer before you put your money in. And you also need to understand the difference between long and short-term capital gains tax, but I'm going to show you that in just a second. So just for example's sake here, guys, Acorns and Stash are pretty popular investing apps out there that pretty much make it as easy as possible to invest. However, both of these do charge a monthly subscription, and this is something that you should be aware of before you invest, because what a lot of people may not know is that there's other free alternatives that you should just be aware of what options that you have. I think a lot of Acorns and Stash investors may be entirely unaware that there's other apps out there that do things that are very similar and they don't charge you. So at the end of the day, I hate paying money for nothing. And, I'm sure a lot of people do like what Acorns and Stash have to offer, and they have things that go above and beyond just the investing. So if you're using the full suite of products, it's probably worth it. But if you're just investing, consider the free alternatives and just understand that you don't have to pay, even if someone is trying to charge you. There's probably, free alternatives available. And just to show you guys the difference here between short and long-term capital gains tax, this is from Financial Samurai, just to give them credit here. So on the left is the short-term capital gains tax rate, and this is the same tax rate as you pay for the money from your job. So short-term capital gains would be if you bought a stock and then sold it within 1 year. If you do that, it is a short-term capital gain, and you're going to pay the maximum amount in taxes. Now, long-term capital gains are for stocks that you hold for longer than 1 year. So I know this sounds crazy, guys, but if you bought a stock and then you sold it 365 days later versus 366, you could potentially pay double the amount in taxes. I know this sounds crazy, but let me show you right here. Maybe not completely double, but pretty close to it. So look at the bottom bracket right here. If you're in this particular bracket, if you have a short-term capital gain, you're going to pay 37% tax on that gain. But let's say you waited one more day until day 366 and it became a long-term capital gain. Well, that just went from 37% down to 20%. That is a massive difference, almost double the amount of taxes. Now, this is based on the current tax code, which of course could change in the future, but as of right now, there is a huge incentive towards being a long-term investor in terms of the favorable tax environment. And so keep in mind, all of those people that are showing those trades on Wall Street Bets, all the short-term traders, every penny that they make, unless it's in a Roth IRA, which it's typically not, is going to be paying the maximum amount of taxes over here on this left category. If you decide to become a patient, long-term Warren Buffett type investor, you get to jump over here into the favorable tax pool. So if you want to trade and pay potentially up to double, almost double the taxes, you certainly can, but long-term investing is much better in terms of the tax situation, and not to mention, most people have better success being a long-term investor versus a short-term trader or speculator. And just to show you guys this unfortunate tax bracket here, if you make $200,000 to $425,000, if it's a short-term capital gain, that's 35% taxes. If it's a long-term, that's only 15%. So if you had a short-term versus a long-term capital gain, you're going to pay more than double the amount of taxes. Let that sink in, guys. Keep that in the back of your head. Always think about the taxes associated with an investment. Short-term trading, maximum taxes. So lesson number 5 here, guys, is a pretty simple one, but it's still very important. And that is to watch out for your desire to compare yourself to other people. There are thousands of stories where someone timed the market just right. And if you go on Wall Street Bets, you'll be plastered with examples of that. But again, keep in mind, guys, that is the far and vast minority of people having that experience. Most people, when they speculate, they typically lose money. Now, with the meme stock situation, there are some isolated examples, and to be fully transparent, I am diamond handing some AMC myself, and I do have some GameStop that I'm holding on to, so I'm part of that movement as well, but it's a tiny, tiny fraction of my portfolio. That's the important distinction here. So you have to remember with the stock market that everyone starts somewhere, and every large portfolio started with $1 somewhere or $100, whatever it may be. Everyone started somewhere. And it's not really like, you're on a team sport with the stock market. It's actually more similar to golf, where you're pretty much just, keeping track of what you're doing and correcting yourself as you go and learning to become a better golfer. So I like golf. That's one of the things that I enjoy. I'm not very good at it, but the stock market reminds me of golf. You learn the strategies, you adjust your swing as you go, and then you're never going to be perfect at it, but you'll eventually get to the point where, most of the balls that you hit go where you want. And if they don't, you understand why they did. That's where you want to get with the stock market. So number 4, guys, is watching out for your percentage gains. So a lot of people look at their return and think it's too small when they get started with the stock market. And that is because they're often focused on the dollar returns and not the percentage returns. So for example, you might be discouraged if you had a 20% return on a small amount of money. But a 20% return could actually be really good, especially if that was like a 1-year return. But when you're investing $50, a 20% return or $10 may not seem substantial. But on the other hand, if you had $10,000 invested, that same 20% return would mean they would have made $2,000. So do not compare your 20% to somebody else's. If you're going to compare, look at it on a percentage gain basis. Do not focus on the dollar amount gains because honestly, guys, that is entirely irrelevant and based on factors you do not have control of. Lesson number 3, guys, is to watch out for the stock market gurus out there. These are people that are looking to sell you information on the stock market. Now, of course, I should call myself out for doing that in the past. However, I always felt that my 15-hour, stock market course, which has been distilled quite a bit into what's on YouTube, was super valuable. And I always had a refund policy, and I had many students do really well with it. And that's the exact information that is now in that condensed version over here on YouTube. But this is actually the exact reason why I stopped selling that stock market course, is because of the millions and millions of gurus out there. And I just didn't want to be lumped into that category. I make plenty of money with the stock market and my different online businesses, and I'd rather have the information available to the people for free. I'm tired of these gurus. I'm tired of people selling BS out there. I like putting out free information like a mini college course. And that's basically the ethos behind these videos here, guys, is information like this should be available. It shouldn't be something that you have to pay for. And honestly, guys, anytime you're investing money in stocks, real estate, anything out there, if somebody hears that you're investing, they know you have money. And if they know you have money, they're going to try to get some of it. So they're going to try to sell you something that you probably don't need. Now, again, Stock Advisor, it's up to you to decide if that's worth it to you. I find it's fairly inexpensive. And again, if you get one stock pick in there that's really good, it could pay for the lifetime of the service. So that is something I deem valuable, but just be careful of spending hundreds or thousands of dollars on trainings or courses. A lot of it's BS, guys. There's a lot of scams out there. So not going to go into it, into too much detail here, guys. So at the end of the day, get your information from a reliable source. I trust the Motley Fool for their free and paid information through that service, and that is from reading and being an active consumer of the Motley Fool's content for at least the last 5 years. Lesson number 2 is being able to complete the elevator pitch, and a lot of people simply cannot do this with their investments. And the elevator pitch comes down to being able to explain why you bought a stock or an investment in the first place and what was the decision-making process. So did you choose a stock because your buddy told you to, or did you actually conduct your own research? So you can do this test with yourself right now. If there's companies that you currently own, see if you can do a 30-second elevator pitch and explain the gist of what the company is doing. If you can't, you probably have no business investing in that because you don't understand it. And if you don't understand it, how can you determine if it's good or bad? If you don't understand it, that's the typical problem people have with the stock market, is investing in things they don't understand. One of my very first examples of this was buying into a biotechnology stock, biopharma stock, because I had seen it go from $40 a share down to $8. The company was called Chimerix. I have no idea what's going on with it now, but I eventually sold it for like $2 a share. I bought shares at $8. I bought like $200 worth when I just started trading. I had no idea why the price went down. There was no research. I simply said it went from 40 to 8. It must go back to 40. No, it didn't. Spoiler alert. So that is not a strategy, guys. Trust me there. That was my experience with it. So if I was able to do that elevator pitch, I could have explained it. But if I was able to do the elevator pitch, I probably would have known why the stock went from 40 to 8, and I wouldn't have bought it in the first place. So before you buy something, you should be able to do a 30-second elevator pitch, test it yourself, and that is going to help you have confidence with your investment, and it's going to help you to ride out those highs and lows. Not so much the highs, mostly the lows. And again, the highs, you should have a plan early on for a price that you'd be willing to sell for. And again, now that we understand investment taxes, that should tie into that plan of understanding whether or not you're setting yourself up for short-term versus long-term capital gains. And then the final lesson comes down to the lesson of loss. Every single person watching this video, I promise you, you're going to lose money at some point in the stock market. But what does that actually mean? Because a lot of people have paper losses that they're calling an actual loss. But at the end of the day, keep in mind, it's not a loss until you sell. Now, I'm not just telling you to go out there and hold on to everything, because there are instances where something is just going down and down in value, and maybe you should just get out of it. Not every loser is going to turn back into a winner, but if they have a long track record, they probably will. Honestly, looking at General Electric, I should have held on to that. I sold at about $7 or $8 a share, and it's a lot higher than that now, but I lost patience with it, and I said, I'm tired of it. I want to take this, capital loss to offset some other gains, and I just want to be done with this company. But, had I held on to it longer, that would have trended upwards. But that doesn't always happen. But understand that everyone is going to lose money in the stock market at some point. Even experts make bad choices sometimes too. And I am not calling myself an expert. I'm just an average guy who invests and shares about it. Don't lose confidence in yourself if you lose money. Learn from the experience and move on. It's just like golf. If you hit a ball and it goes off in the wrong direction, just kind of think about, okay, what was it about that swing that was different from the rest? What could have caused that to happen? If you have a bad investment, go back to your plan if there is one, and if there's not a plan, well, that could be the problem right there. But understand what caused you to experience that loss, and if there's anything you could do to prevent it in the future to improve your strategy. You can understand the historical financial returns of a company. You could understand every piece of information, but no one can predict a company's future with 100% accuracy. Also, one quick final thank you message here to the Motley Fool for sponsoring the video here, guys. Also, guys, if you end up deciding to join the stock advisor service from the Motley Fool, you'll also get immediate access to their 10 best buys list now, right to your email inbox. Or you can go to fool.com/Ryan to get your hands on that list today. So anyways, guys, that is going to wrap up this video. I hope you enjoyed it. Once again, thank you to the Motley Fool for sponsoring this video. I would love to work with them in the future, and I am looking forward to seeing what else is on the Stock Advisor in the coming months. And I'll keep you guys updated if I decide to make an investment in any of those picks in the future. Like I said, if you want to grab that top 10 list from the Motley Fool, that's the top link down in the description below. If you're completely new to the channel and this is your first time seeing me, make sure you subscribe and hit that bell for future notifications. If you made it all the way to the end, go ahead and drop me a like and, I don't know, make fun of my shirt or something like that, or maybe my haircut. Whatever you think, guys. Anything like that. Thanks so much for watching and tuning in, and I will see you in the next video.